What's going on, guys? It's Keith Frizzley with Think Stocks, and in this video, we're going to talk about leveraged ETFs. Now, before we jump into what a leveraged ETF is and if it's possibly a smart investment, we need to understand one basic concept, and that's called margin. Now, some of you may already know what margin is, but for those of you who do not, let's just do a real quick review and let's just catch you up to speed. So let's pretend you want to purchase a house, and that house might be, say, $500,000. Now, I understand most of us may not have that much money in the bank account, but let's say you saved up $100,000. Well, where's this extra $400,000 coming from? That is coming from the bank, where you will get a mortgage. We all know what a mortgage is, or we should. If not, get off this video and go learn what a mortgage is. But you need a mortgage. It's going to be an additional $400,000, and then you will have a mortgage for whatever, 15 or 30 years, paying back at 3% or 2% interest. I think we all understand the concept of a mortgage. Well, it's right here. That's leverage. This is leverage in a nutshell. You have $100,000, and the bank is willing to give you an additional $400,000 so you could buy a $500,000 house. Without leverage or margin or a loan or mortgage, whatever you want to call it, you wouldn't be able to buy this house. So now you understand what margin is or what leverage is. So let's show an example of if you had a brokerage account, and say you deposited $10,000 into your brokerage account. You have to qualify your account to be considered a margin account, which is pretty much you only need $2,000 for it to be margin. So as long as you have $2,000 in the account, you can now have a margin account. So what they will give you, so if you have $10,000, you can now get an additional $10,000 to trade with. So your buying power is now $20,000. Really simple to understand. It's right there. You have a cash account, you turn it into a margin account. They will match you double what you have, and you could trade with that. So say you want to buy $15,000 or $20,000 worth of a stock, you can now do that even though you only have $10,000. And for you day traders out there, some accounts will give you 4 times leverage. So if you put in $10,000, then you will get $40,000 of buying power. So it's very helpful for day traders, but all of this comes with a major risk factor. So let's talk about that risk factor really quick, and then we will get to the leveraged ETF. So if you say invest in a stock, you buy Apple. Apple splits, it's now $100 per share. You have $10,000 in account, you get a margin account, you now have $20,000, and you figure, let me put all $20,000 into Apple. Next thing you know, Apple plummets. It goes lower than $50. It goes all the way down to $40. You now lost $12,000. Even though you only had $10,000, you lost all $10,000 that you have, plus the $2,000 worth of margin that the bank gave you. So now something's going to happen, which is called a margin call. You now owe the bank $2,000. That's why a lot of people will tell you margin is very risky. It's risky because you could lose more money than you put into the account. And because of that reason, a lot of people will stay away from margin. Margin is like a loaded gun. It can be very powerful, very useful, but you need to understand how to use it because it can be very dangerous. It's especially if you're day trading and you have 4 times margin or 4 times leverage, whatever you want to call it, you could lose 4 times the amount. Day traders typically need $25,000. So they can deposit $25,000 into their bank account, and they'll have $100,000 to play with. And if they make the wrong move, they're maybe investing in penny stocks that are very volatile, and it plummets down 50%. Now they're out $50,000, even though they only put $25,000 into their account. So that's why you need to be very careful with margin, and that's why leveraged ETFs are this amazing, I wouldn't call it a tool, but just amazing option to invest in. So we're going to take a look at Robinhood. We're on the desktop version of Robinhood, and this is the QQQ. This tracks the NASDAQ. It is an ETF. And as you can see, over the past month, it's gone up almost 5%. Over the past 3 months, 21%. If we want to look back a year, you can see right here, this is before the coronavirus. It was $236 per share, and it plummeted all the way down to $169. So that was a pretty massive drop. If we do the math really quick, we're down about 28%. So that's a huge drop. And you'll see why we're talking about this in a second. But let's go back to the 1 month. This is the NASDAQ. Now there's a ticker symbol called QLD. It's QLD right here. Pro Shares Ultra. This is the leveraged ETF. If we scroll down to right here, QLD provides 2 times leverage exposure to a modified market cap weight index. You could read this. I don't need to read it for you. But what this is a leveraged ETF. You do not need margin to buy this. If you have $176.86 in your brokerage account, you can deposit it right into this share, this ETF, and you don't need a margin account. That's the great part about it. Essentially, what's happening here is this ETF is taking on the risk. Every morning, they are taking whatever money they have from their investors, and they are using that to have the margin. So they're taking on all the risk. So if this plummets, no matter how much it plummets, if it goes down to zero, you will never lose more than you put into it. So you don't need to worry about margin. I need to make that very clear. If you buy into a leveraged ETF, you do not need to worry about margin. You don't need a margin account. You will never lose more money than what you put in. You could lose all your money, or at least 90%, and we'll get to that in 1 second. So before I start to show the difference between the two, there's one more I want to show you, and that is the TQQQ. Pro Shares Ultra Pro. And what is this? This is leverage times 3. So as you can see, this will have 3 times the leverage. So now let's compare all of them. We go back a month. This is up 13%. The leverage times 2 is up 9%. The leverage and then the regular ETF is only up 4.67%. So here's your 2 times leverage, and here's your 3 times leverage. Now you might be wondering, okay, it's not exactly the same, and it's not going to be exactly the same. You'll never have it perfect, and that's because during the nighttime when these are being traded after hours or before hours, the margin might not exactly line up, and that's called drift. You could look into drift. I'll put an article in the description where you could read more about leveraged ETFs, but just what you need to understand is if you're investing in a leveraged ETF, you're not going to get perfect leverage. It's not going to be exactly times 2 or exactly times 3. There'll always be that room for error. And when the market goes up a lot or goes down a lot, that margin for error will exponentially grow. Here's what I mean. If we go back a year for the 2 times, the original, and the 3 times leverage, let's just organize this. We'll go back to this. We were at 236 and it plummeted all the way down to $169. If we go to the 2 times leverage, it was 150 and it plummeted all the way down to $83. That's almost 50%. And get this, if we go to the 3 times leverage, it was $118 and it plummeted all the way down to $37. You lost around 80% of your shares, of your value, in the matter of a couple of months with a 3 times leverage. So this, the normal ETF is 28, and that's what people need to understand. You could get 3 times the profit going up, but you could also get 3 times the losses going down with the Ultra Pro NASDAQ. And same for the double. It could either go up twice as fast or down twice as fast. So that's why you could have these major losses like this. But this is the perfect time to buy when it was $40 because that, or 35, you could see when it hit 35, it skyrocketed all the way up to $126. That is a massive return on investment. If we look over the past 3 months, 73%. For the times 2, it was 46%. And for the regular one, it was only 21%. So if you knew this is the bottom, let me buy into an ETF like the NASDAQ, but if you want to do 3 times better and get 3 times the results, you could buy in to the TQQQ and get 3 times leverage without taking on any additional risk. You're not buying into you don't have any margin whatsoever. You could just have a normal cash account and invest in leveraged ETFs. And before we even talk about if it's worth investing in in leveraged ETFs, I also want to just tell you that the SPY also has leveraged ETFs. So here's the normal SPY. The SSO is 2 times leverage, and then the UPRO is 3 times leverage for the SPY. So if we just look really quick over the past 3 months for all of them, there we go. It went up 15%. For the double, we got 31, and for the triple, it was 48%. So again, not perfect, but you could see that this is positive slippage. So if it only went up 15% there, here it went 31%. So we're getting that positive drift up, and that's 48%. It should have been 45 for a perfect 3 times leverage, but it's a little bit more. That's called positive drift. But remember, drift could happen both ways. Drift could be positive or negative. So now the question is, should you invest in a leveraged ETF? Well, if you're on the older end of the spectrum, I'm talking about maybe in your 40s, 50s, or 60s, don't go near these. Again, I'm not a financial advisor, not financial advice, more of an opinion. I would not go near these if I was 40 or 50 or 60 years old. And that's because if we do have a market downturn and the market drops 20, 30%, if we have another year like 1987, which we kind of did with the coronavirus, it plummeted over 20% in the matter of 1 or 2 months. If that happens, then as you were able to see, whether it be the UPRO or the TQQQ, you could lose almost 90% of your position. You put $10,000 into one of these, and next thing you know it, your account is all the way down to $1,000. You just lost $9,000. And what if that was even more? What if it was 100,000 or $1 million? So it is higher risk. You could lose almost your entire position, but you can't lose more than what you put in, unlike margin. So who should invest in leverage ETFs? And should you even touch them if it could drop down 90%? Well, with that being said, if you are younger, if you're in your 30s or 20s like me, I'm 25, yeah, I'd say buy up a few shares. Don't have a lot. So you all know I have my brokerage account, I have my TD Ameritrade account, and that's where most of my money is. And then for Robinhood, if I go to my portfolio, you can see here's my portfolio. It's only $450. It's very small, but I have 3.58 shares worth of the TQQQ. So if we go back the past 3 months, let's go back even further to a year. This is when I sent out the request to get a lot of people to download this app. So I got a bunch of free stocks. I didn't put a single dollar into this, and I sold all of them, and I bought into the UPRO for a little bit, and then right about here I sold the UPRO, and then I bought into the TQQQ, and it's been going up. Over the past 3 months, I've gone up 15%. The past month, 8%. You can see right there. That's where I sold the UPRO, and then right here is where I purchased the NASDAQ leverage times 3. And it went from $400 to $450 in the matter of 3 weeks. So it is going up quite rapidly. But if it drops, I really don't care. This is play money. The $454 is not much for me compared to my other account. So I'm just putting it in, see what happens. Maybe I'll put a couple other $100 into it, but I'm not gonna go crazy with it. So if you want maybe a risky bet, or you want more of a speculative bet, put maybe a couple hundred or a couple thousand, depending on how much money you have. I wouldn't say any more than 5% of your overall wealth into a leveraged ETF. Because as long as the market continues to go up, you could get some serious gains with this, especially the 3 times leverage. The market goes up, say 30% in the next year, I'm gonna be getting close to 100%. So if I put in, say $1,000, or even if I just keep that $400 in, within a year, I'll have $1,600 from that. That'd be a pretty good return on investment. But again, I'm not gonna get super risky. It's not like I'm gonna drop $8,000 or $9,000 into it. I'm going to stick with my 14 stocks that I buy. That's where I'm gonna put most of my money. It's a safer bet. But I want you to all know that leveraged ETFs are a thing, and this is how they work. So now, I want to pass it off to you guys. Leave some comments below. What are your thoughts on leveraged ETFs? Did you know about them before this video? Did you not? Now that you know about them, are you going to maybe put some money into it, or do you think it's too risky? But other than that, I'll see you in the next one.